global share markets posted solid returns for the month of February. International shares were up 1.64% and Australian shares were up 1.48%. Australian bonds minus 3.58% and international bonds minus 1.56% posted poor returns for the month of February. Global bond markets sold off and bond yields surged over recent weeks as investors started to price in the potential for higher inflation and for interest rates to increase quicker than anticipated. This was driven by the strong recovery in global economic growth and the $1.9 trillion US fiscal stimulus bill rollout. The rise in bond yields in an environment such as this, shortly after a recession, is unsurprising. This is in line with past cycles. With global economic growth rates at pre-pandemic levels, bond yields would also be expected to rise to pre-pandemic levels. The tech sector is impacted more than most by rising bond yields, as increasing discount rates undermine the value of long-term cash flows and company valuations. We don't expect to see persistently high inflations above targeted levels. High levels of unemployment, spare business capacity, and low wages growth should keep inflationary pressures in check. The US Senate has passed President Biden's US $1.9 trillion COVID relief plan. The key to the success of this is that money flows into the economy and not into savings accounts. US Q4 20 earnings wrap up a good result overall. S&P 500 companies reported growth in earnings of 3.9% for Q4 2020. 79% reported earnings per share above estimates, one of the highest on record. However, share prices of those companies that have reported positive earnings surprises fell 0.1% on average. An encouraging sign is that Q1 2021 earnings per share estimates are continuing to be revised upward. As the recent second half 2020 earnings season has come to a close, Australian second half 2020 earnings and dividends are up strongly. Almost 60% of the S&P ASX 200 companies that reported earnings reported profit increases, with just over half beating expectations. Just below half increased dividends, with banks and resources companies with notable dividend increases. Expected 2021 earnings growth has been revised to 35% from 20% a month ago, with resources and banks sectors to feature in the strong earnings result for financial year 2021. And on to our investment strategy and outlook. We expect shares to hold up well and generate reasonable returns over the short to medium term. A recovering and momentum-driven global economy, solid earnings recovery, low interest rates for at least the next 3 years, the vaccine rollout and US sizable stimulus package should support equities over the next 12 to 15 months. We expect the Australian dollar to continue its journey upward and benefit from the upcoming super cycle. We maintain our strategy of hedging our foreign currency exposure. We anticipate more upside potential in cyclical sectors relative to tech and healthcare sectors. Our exposure to small caps should continue to provide an important source of alpha for our client portfolios. A lower interest rate environment and an improving economic outlook for Australia should continue to support small cap returns.